Gold and silver are climbing. Why are they climbing? And what does it mean? Is the correction over? Should you hold on? Or is now the time to take profits? Let's take a look. As I record this, both gold and silver are pushing higher again. And while the headlines reach for neat explanations about the shutdown, the Senate, or the latest whisper from the Fed, the truth is boringly less dramatic and far more durable. Because we are not watching a speculative detour, we are watching what is a very long journey resume. The story here is that the bull market in monetary metals, which was paused by a bit of a violent pullback and some profit taking, has reverted to a prior path because the underlying drivers, they never left. If we start with volatility, because it is the part that everyone feels first, then look at Metal Focus's Chirag Sheth, who says that volatility of $400 to $500 per ounce per quarter is likely, with gold consolidating at $3,800 to $4,600 band and silver eyeing $58 to $60. These are both prices and another way of saying the path of least resistance is still higher, but progress will be messy. Silver is supported by structural deficits, new industrial demand, and the capital spending wave around AI and electrification. And if you remember, volatility is not some verdict on the value of those metals. It's simply a kind of tax that you have to pay in order to stay on the right side of monetary history. Now, if we look over to Washington, where short-term theatrics continue to obscure long-term reality, political dysfunction, fiscal stress, and the cumulative economic cost of policy paralysis, they are what keep investment demand for gold and silver alive. The near-term swings are noise, while the incentives are structural. Even if a government reopening brings a burst of data and a round of relief, the deeper issues will still remain. Once more again, for those late to this party, the flaws in the system are not being fixed, only deferred. Now, if you look at yields, they are rising for the wrong reason, and not because growth is accelerating, but because deficits near 6% of GDP and relentless treasury issuance are making bond markets uneasy. And that matters for gold and silver, because the textbook link between higher yields and weaker metals assumes those yields reflect confidence in growth. And when they instead reflect unease about fiscal control, well, gold and silver are the logical beneficiaries. If you add in Washington's experiment with politically timed handouts and tariffs disguised as dividends, and you have an economy fueled more by improvisation than prudence. Even if courts or Congress eventually reverse some of these policies, the arithmetic does not change. Debt remains the central problem, and the headlines may shift the sort of route, but not the destination. Now, from a broader perspective, even the more optimistic institutional analyses now accept that gold's pullback looks like a pause with an enduring uptrend, not the end of it. Political risk has not vanished. Global debt is still expanding faster than growth, and central bank demand continues to reinforce what investors already sense, that holding tangible, sovereign-free assets is rational, not radical. The numbers are interesting, but the mindset shift is the real story, because gold is no longer an alternative. It's an insurance against a system that has very much forgotten what prudence looks like. Now, silver, as usual, is the unruly cousin. Clearing resistance near $50 may be some kind of technical event, but the more important story is fundamental. The metal remains in consecutive annual deficits. Industrial demand is robust, and investor positioning still trails its own historical averages. And of course, throwing its new spot on the critical minerals list, more on that on Thursday, by the way, history shows us that in every major bull market, silver ultimately outpaces gold, but the leadership change never happens early. So if you think we are at the end of this move, you are also assuming that younger investors, newer investors have already piled in, and that sentiment has gone euphoric. But neither is true. This market is still patient, it's still cautious, and it's far from overextended. Now, that brings us to the biggest shift taking place, a view that you will hear more and more places. During the decades we called the Great Moderation, the world considered United States treasuries and the dollar as a kind of ultimate yardstick of value. Now, of course, that regime kind of began to crumble during the pandemic. And since then, gold has been re-emerging as the only neutral collateral, the one asset not dependent on anyone else's solvency. Central banks are not buying gold out of nostalgia. They are buying it because trust has become a scarce commodity. And many now hold 5 to 10% of reserves in bullion. And that trend is broadening. It's not fading. Now, some argue that once the shutdown ends and the Fed resumes easing, gold should retreat like any other fear trade. But that misunderstands what is driving this cycle, because gold's strength is not about panic here. It is about arithmetic. Deficits north of 5% of GDP and a slowing economy are not sustainable without some blend of financial repression, currency erosion, or even heavier taxation. None of those outcomes threaten gold's real value. They reinforce it. So when rates are cut into weakness, it is not a sign of policy success, but exhaustion. And when the cost of capital falls for the wrong reasons, the appeal of an asset with no default risk naturally rises. It's not just common sense, because it's human instinct even. Now, on tariffs and policy drama, the same principle applies. If tariffs are overturned, equities will cheer briefly, but the government's revenue gap only widens. If they are upheld, inflationary pressure and global friction persist. Either way, the fiscal credibility problem remains unsolved, and investors will continue to hedge not against any single decision, but against the chronic instability of policymakers to align promises with mathematics. Now, for those who prefer timelines, the consolidation after the May peak near 3,500 lasted roughly 4 months. Momentum returned in late August, eventually carrying gold close to 4,400 and silver to the mid-50s, before corrections of about 11 and 16% reset positioning. That pullback flushed out weak hands and created a stronger base under unchanged fundamentals. And since then, central bank demand has stayed firm. ETFs, they're stirring again, and the market keeps buying dips even on yield up days. So the sensible approach is not to chase short-term price targets, but to understand the drivers. They all rhyme with the same words: fiscal credibility, political instability, and the slow realization that when money creation outpaces growth, purchasing power leaks quietly away. Now, if you hold silver, patience is your best trade. Its leadership phase always arrives late in the cycle, and when it does, the move is usually fast and decisive. If you are new to this space, decide whether you are hedging the next headline or the next decade. Physical ownership without counterparty exposure remains the foundation of true diversification. And if you already hold metal, ignore the temptation to micromanage every price tick. Watch the meaningful signposts instead. Gold's behavior near 4,200, silver's threshold around 50, the government's debt auctions, and the pace of central bank accumulation. Those are the metrics that tell you whether confidence in the system is holding or quietly slipping. And one final thought: this is not mania. Interest in precious metals is rising, but the tone of this market remains measured. It's analytical. It's far from euphoric, and that is healthy. The real top comes when enthusiasm replaces reasoning. For now, gold and silver are simply reclaiming their role as assets that do not depend on promises. And that is precisely where serious investors want to be. So the headline today is simple: own the asset that does not require anyone else to behave, and let volatility do what it always does: try to shake you out of position that you will be proud you kept. And if you want to find out more about how you can get gold and silver into your portfolio, why not click on the link below and book a free strategy call.